Okay, so we're now digging into cost concepts. For your exam, it's fundamental to understand the three legs of the manufacturing cost tripod. Okay, so if we're making wooden chairs, wood would be a great example of our direct materials cost. But in order to produce chairs, we need somebody to make the chair itself. Okay, so the second element of manufacturing costs would be our direct labor costs. A carpenter would potentially be representative of our direct labor costs in this example. And finally, our third leg to the tripod is manufacturing overhead. Okay, so manufacturing overhead could basically mean anything that is not direct materials or direct labor. So this could be our factory space, could be depreciation, could be tax expenses. Okay, so anything else. All right, you crazy kids, let's talk about cost accounting. Okay, so let's first refresh our memory with the whole point of managerial accounting, right? Why is this different from understanding financial accounting? So for those of you who've already taken the FAR exam, you probably understand that FAR is going to be an exam for financial accounting, right? The whole point of financial accounting is going to provide information to external decision makers, whereas managerial accounting, aka what we're learning in the BEC exam, is going to be testing your knowledge on how to provide information for internal decision makers, okay? So internal managerial, external financial reporting. Okay, so we're now shifting gears and moving on into the more costing section of this exam, all right? So something else that's going to be heavily tested for BEC. So we have a lot to talk about. Okay, so first and foremost, what is the idea of cost and why is this important for companies' operations? Well, it doesn't take somebody with an accounting background to understand that cost is going to be one of the fundamental concerns for starting or operating any business. Okay, so as accountants, we have to know how to allocate cost. And the whole idea of cost allocation is that we're taking a sum of all of our costs, right? It could be rent expense, could be cost of goods manufactured, could be the cost of our inventory, our selling expenses, sales or general administrative expenses, right? Those secretary costs, those are going to be all of our costs. What we need to understand is how to allocate those costs to the respective cost objects. Okay, so the primary objective to cost allocation is properly assigning costs to their individual departments, their individual products, or product lines, right? So these are what we're referring to when we're talking about cost objects. So some of the terms you got to be familiar with are going to consist of the following. Cost pools, right? So these are going to be groups of individual costs. So generally, these are going to be by department or services. Cost allocations are generally going to be derived from cost pools, okay? So important to note, this is the sum of all of those costs that we were talking about, right? Like a swimming pool of costs. Taking a look at this example, the cost of an organization's maintenance department is accumulated in a cost pool and subsequently allocated to various departments that use its services. Okay, so if there's a specific department that is providing a service, but that service is affecting various departments, various segments of the business, we need to allocate those costs to the respective cost objects. Okay, another good one could be an IT department, right? Information technology. Very frequently, they will be helping various segments of the business with their IT. It's important to allocate those costs accordingly. Cost allocation base. Okay, so this is going to be an activity measure that is used to allocate cost pool dollars to the respective cost objects. Okay, so how are we allocating these costs? That's the question at hand. And a cost driver. So this is the activity that results in a cost to increase or decrease, right? So what's driving our cost? What's causing it to increase or decrease? Okay, so those are the basic terms that you should have a general familiarity with. They're not going to be the main concepts that will be tested, but they are terms that you could very easily see within the context of a question. So for the purposes of understanding the language of cost accounting, it's good to know these terms as well. Okay, so at the end of the day, we're going to be taking these costs and allocating them to the respective cost objects, right? So these cost objects, just a general way of saying products, right, or goods, could be machinery and equipment. This is the object that we are tracing those costs back to. All right, so snowballing into the definition of a cost object, right? So cost objects are anything for which managers want a separate measurement of cost. They are going to be considered resources that provide management with a basis for making decisions, and they could be anything from products, product lines, different departments. They could be geographical regions. Okay, so essentially, cost objects are going to be anything that enable management to make better decisions. So the overall objective of cost objects and just differentiating the different types of costs is going to be to provide a greater overall effectiveness and cost efficiency to the business operations. Okay, so assigning these different costs is going to end up zeroing in on the overall valuation of different costs, right? As well as inventoriable goods. So take note that a single cost object won't necessarily be one measurement. Okay, so cost objects can have more than one measurement, and this can be helpful for enabling management to make more strategic decisions. Taking a look at an example of a cost object. So an automobile corporation would like to determine the costs related to a particular car model. Okay, so each car in the given model is going to be considered a cost object. So additionally, the automobile corporation can determine the costs associated with its US operating segment and European operating segment. So both the geographical locations that we're talking about are going to also be considered cost objects, right? Because as we remember, this could be products, could be product lines, it could be different departments or geographic regions. Okay, so the cost object isn't necessarily always going to be the inventoriable item. All right, so how we're tracing these costs back to their cost objects is going to end up being the question that you got to be able to answer. Okay, so one of the more fundamental understandings you need to have when it comes to cost accounting is understanding the three factors of production. Okay, so what's important to understand about manufacturing cost is that these are going to be capitalized as part of the asset itself. Okay, so it's going to be presented on the balance sheet with the value that is presented as inventory. Okay, so these are going to be presented with each unit that is being sold. So this distinction is also going to be important for understanding how it impacts income. Okay, so when you think of manufacturing costs, you're going to think of them as this tripod of costs, right? So in the manufacturing world, they are going to be considered direct materials, direct labor, and manufacturing overhead. Okay, so the three of these costs are going to be categorized as inventory, but there are some key differences between them. One of the key factors to understand is that both direct labor and direct materials will always be directly traceable to the product itself, but manufacturing overhead is generally not going to be traceable directly to it. So as we said, our direct costs are going to be those costs that are directly traced to the cost object or the cost pool. As we said, these are going to be broken up into direct raw material costs, right? Materials that can be easily traced to the cost object, and direct labor costs, right? Employee wages that can be directly traced to a cost object. All right, so ultimately direct materials are going to be costs that are associated with the purchase of raw materials that will be used in production. All right, so these are going to also include salvage value. So this is also going to include freight in. Okay, so these costs are going to be capitalized to the value of that inventory. Keep in mind, freight in will be included, freight out will not. Freight out is going to be a selling expense to the income statement, not going to be capitalized to inventory. Okay, and once again, direct labor costs are going to just consist of the costs associated with the labor that is applied to the direct production of the product generated. Okay, so let's talk about these manufacturing costs, right? This manufacturing overhead. So these are also known as indirect costs. And these are going to be costs that are not easily traceable to a cost pool or a cost object. So if they're not easily traceable, what could this consist of? So it's still going to be a part of the production of this product, but it's not necessarily going to be traceable to the specific product itself. Okay, so this can include things like cleaning supplies. It can include things like maintenance or janitor staff members. All right, so typically indirect costs are going to be applied to multiple cost pool objects and will require allocation methods for determining which cost object they should be applied to. Okay, so allocation bases are cost drivers that can be applied to allocate indirect costs, right? So generally, the allocation of indirect costs to different cost objects are going to be applied by using something called activity-based costing methodologies, ABC costing, but we're going to talk about that a little bit later. Let's go through a quick example of what different direct costs versus indirect costs would look like. So let's say we're taking a look at a coffee shop, right? And we were comparing the differences between direct and indirect costs. It might look a little something like this, right? So direct costs can include things like the coffee itself, right? Maybe those coffee beans, water, cream, sugar, cups, lids, and salaries of employees that are making the coffee. All right, so that's the key, making the coffee. You could directly trace that salary to the product itself. Okay, so indirect costs, this is going to include things like store rent, right? Depreciation on that store equipment, advertising, the CEO's salary, right? Not somebody who can directly be traced to the cost object. All right, so at the end of the day, these are not going to be easily traced to the cost object. Okay, so let's further illustrate this by taking a look at an example. Express Trains manufactures trains that includes millions of dollars worth of parts each year. Okay, so the company incurred the following costs. We had leather that is used for the train seating, $1.1 million, metal applied to the train's exterior, $975K, salaries of laborers that manufacture the trains, $2.5 million, salaries of executive assistants that order the parts that are applied to the trains, $200,000, and stationary expenses, $55K. Okay, so we want to know what costs would be considered directly traceable, right? What are our direct costs? Okay, so focusing in on direct materials and direct labor costs, we take note that this is going to include the train's leather that is used for seating, that is directly traceable to the production of the train itself, right? The manufacture of that train. Metal applied to the train's exterior, right? This could be a direct material as well, directly traceable to that train. Salaries of laborers that manufactures the train, because it says keyword that manufacture the train, this is going to be a directly traceable cost. Okay, but on the other hand, salaries of executive assistants that order parts that are applied to the trains, right? They might not just be working on the trains, right? They have other job functions as well. It's ultimately a salary that's not directly traceable. And the same goes for stationary expenses, okay? So at the end of the day, stationary can be applied for much more than just the manufacture of the trains. Okay, so the product that will have directly traceable costs will equate to $4.485 million. Okay, so now taking a look at our next example, Unintended Trains. A competitor to Express Trains also manufactures trains that will include many different parts for their successful production. All right, so costs incurred in the production of unintended trains will include the following: leather for train seating, $990,000, metal applied to the train's exterior, $880K, Salaries to the laborers that manufacture the train, $2.1 million. Salaries of those executive assistants, $210,000. And stationary expenses, $45,000, right? We have the same costs. We just now want to know what are the indirect costs that are incurred by unintended trains. Okay, so as we remember, these directly traceable costs, aka the leather, the metal applied, the salaries to the laborers, those are all directly traceable to the train itself, right? So we want to know what are the indirect costs. So these are going to be the non-directly traceable costs, right? So the costs that are not necessarily directly traceable to the production or the manufacture of the product or the cost object. Okay, so salaries for those executive assistants and stationary expenses, those are going to be indirect, as we said previously. These are not going to be directly traceable. Doesn't mean they're not necessary, they are just not directly traceable to the cost object. Okay, so the answer to this question would be $255,000, the sum of the 210 and the 45. Okay, so the major differences between product cost versus period cost is ultimately going to come down to how costs are going to be treated in the financial statements. All right, so product costs are always going to be capitalized and included in inventory, right, aka that balance sheet. Okay, and beyond that, what you need to understand about product costs is that this is going to include 3 items: direct materials, direct labor, and manufacturing overhead that is associated with the cost object, right, also known as manufacturing overhead applied. Okay, so these are going to be considered the necessary costs related to manufacturing those certain products. Okay, whereas period costs are going to be costs that are expensed as incurred and will thus be represented in the income statement. Okay, so product cost capitalized to inventory, period cost expensed to the income statement, right? So period costs are going to be costs that are not considered a necessary part of the manufacturing process, right? Doesn't mean that they're not important, just means that they are costs that are not related to the manufacture of the product, right? So these are therefore not going to be assigned to inventory. All right, they're not going to therefore go straight to cost of goods sold when that inventory is sold. It just means that they're going to be separated on that income statement, all right? So this is going to include things like selling expenses and general admin expenses. Okay, so manufacturing overhead is going to be one of the unique items that can either be a product cost or it could be a period cost, right? Because manufacturing costs are not going to be that specific, right? They're not going to be things like wood in this example, wood going straight to the production of making a chair. And it's also not going to consist of direct labor costs, such as the carpenter making the chair. This can have more of a wide range, okay? So this can include examples such as depreciation, rent and property taxes on the manufacturing facilities, right? So rent's a key one that is going to very often be associated with manufacturing overhead, all right? But it can also include things like depreciation on manufacturing equipment, managers and supervisors in the manufacturing facilities, electricity and gas, right? Everything that we need to ultimately run the business and create this product. And the key difference is that it is not going to be directly traceable to the actual cost object. But what makes manufacturing overhead considered a product cost or a period cost? Right? How do we know when to allocate this to inventory or expense it on the income statement? Right? We remember from our list of product costs, we still have this manufacturing overhead applied. All right, and what's important to understand is that manufacturing overhead can be broken out into manufacturing costs as well as non-manufacturing costs. Manufacturing costs are going to be costs that are included in the manufacturing of a product, whereas non-manufacturing costs, as the name suggests, are going to be all other costs, right? They're not going to be included in the manufacturing of the product. Okay, so manufacturing costs, once again, they are going to be included in the manufacturing of the product. They're going to be treated as a component of inventory, therefore, right? And they're also going to then be capitalized as that inventory as they are incurred. Okay, so although they're considered product costs, they can still be considered either direct or indirect. Whereas non-manufacturing costs, this is going to be an expense as a period cost on the income statement, right? So this is going to include things that are not included in the overall manufacture of the product. This is going to be things like selling, general administrative expenses, right? And they are going to be expensed as they are incurred, right? They're not going to be capitalized as inventory as if they were a product cost, right? That's the whole idea and the big difference between product and period costs. All right, so if you're thinking about manufacturing and non-manufacturing overhead and you're associating it with rent, a prime example of manufacturing overhead, key difference between manufacturing and non-manufacturing is that manufacturing overhead is going to be things like the factory expense, right? The factory warehouse where the actual product is being created. Therefore, those expenses are going to be going directly to the balance sheet as part of that inventory. Whereas rent, where the accountant would work or general administrative tasks would be done, right, could be the office where secretaries or executive assistants are located. That is going to be rent that is applied as a period cost, right? So therefore, those are going to be rent expenses that are located in the income statement. Okay, so taking a look at this example, Universal Inc. incurred the following costs during the most recent calendar year. They had selling expenses, general admin expenses, salaries of manufacturing employees. They have purchases of materials, internal legal salaries, manufacturing overhead, and outsourced accounting fees. What do we want to know? We want to determine which of the above costs will be considered a part of their product and period costs, right? So we're going to break out the product and we're going to break out the period costs. So let's remind ourselves, what is the difference between product and period costs? Product costs are going to be those costs that are capitalized and will be included in inventory, okay? Whereas period costs are going to be those that are expensed as incurred and will be represented on the income statement. Okay, so going through this, what are examples of product costs, right? We're looking for direct materials, direct labor, and manufacturing overhead that is applied to production. So this is a great example of a type of question they might ask you on the exam. They might give you a set of data and ask you to calculate just one topic, right? They might ask you to just calculate the product costs or the total period costs. So it's going to be up to you to go down the line and bucket these into the respective costs. Okay, so selling expenses. This is going to be a period cost, right? So this is going to be directly applied to the income statement. Same with general admin expenses. Right, these are going to be period costs as well. So directly traceable items is what we're looking for when we're talking about product costs. Salaries of manufacturing employees, these are going to be the labor salaries for those employees that are directly contributing to the production of the cost object. Okay, so this is going to be a product cost. Purchase of materials, right? Materials are always going to be directly traceable to the cost object. So the purchase of materials are going to always be product costs. They're inventoriable. Internal legal salaries. So what do we remember about legal salaries? These are going to be non-manufacturing costs. Okay, so they are not going to be applied to the cost object, and therefore they are not going to be directly traceable to the inventory itself. Okay, so they are going to be period costs as well, straight to the income statement. Manufacturing overhead, okay, because it's manufacturing overhead that applies to the actual manufacture of the cost object, keyword is going to end up being manufactured, right? So therefore, this is going to be directly traceable and it is going to be a product cost, right? Had this been overhead that is applied to something like office space, a place where the sales team would work, a place where the executive assistants would work, the accountants would work, the lawyers would work, right? Those would not be considered product costs because they would not be applied to the actual manufacture of the cost object. Okay, but because this is manufacturing overhead, it is going to be directly traceable and applied to the cost object, right? So therefore, that's going to be a product cost as well. And finally, outsourced accounting fees. We know by now this is going to be a period cost, right? So therefore, that's going to the income statement. And now we can go ahead and calculate all of our product costs and all of our period costs, right? So the summation of our product cost is going to be 1.3 million. The summation of our period cost is going to be 287,000. All right, and further breaking out manufacturing costs into prime costs and conversion costs, right? So this is super easy points on the exam. Totally inexcusable to get them wrong. We just need to do a little bit of memorization. All right, so great flashcard material. Whip out those flashcards. This is Flashcard City. You need to know how to bucket these into prime costs and bucket them into conversion costs, right? So prime costs are going to consist of direct materials plus any direct labor costs, whereas conversion costs are going to be direct labor costs plus factory overhead costs, okay? So they're not going to be mutually exclusive events. As you can see, the common theme here between prime and conversion cost is direct labor, right? Direct labor can be considered either a prime or a conversion cost. So simple to remember, if you get a question asking for either of these two, always think of direct labor. This is always going to be included in the calculation. Okay, so when you think about direct materials and direct labor, these are going to be considered prime costs, right? But an easy way to remember this is that these are going to be the primary costs to creating a product, right? So let's say that we are manufacturing chairs. Okay, so assuming we're making wooden chairs, wood would generally be the direct materials associated with the creation of those chairs, whereas this carpenter here would be the direct labor associated and directly traceable to these chairs, right? So these are the primary costs to creating the product, right? So they're the prime costs. So conversion costs, on the other hand, will be the costs that are necessary to convert this into a finished product, right? So this is going to consist of direct labor, right? Our carpenter here. Whereas manufacturing overhead is going to be the location where this wood is converted into a chair. Okay, so at the end of the day, this is going to be where we are converting our materials into finished products, all right? So these are going to be costs associated with the combination of direct labor and manufacturing overhead. We got to know the differences between prime and conversion costs, like I said, super easy points.